Hello there, and welcome to a financial news sweep for February. While the suspicious death of Alexei Navalny, the imprisoned Russian opposition leader to Putin, was major news, it doesn't really fit in a financial sweep such as this one. But let's start off in another communistic dictatorship, namely China. Xi Jinping's never-ending headache. I guess you all remember Evergrande, the former world's most valuable real estate company which crashed in 2021. After decades of massive urbanization, a period of overbuilding, in combination with Chinese regulators posing stricter credit limits on the real estate developers, Evergrande brought much of the housing sector in China with it in its crash. Many hundreds of thousands of Chinese citizens who paid upfront for unbuilt apartments have seen their life savings evaporate. But the despair doesn't stop there. The housing bubble has spread into the Chinese economy and its stock market too, causing quite the headache for the Communist Party and Xi Jinping. On February the 5th, the Shanghai Composite plummeted to a 5-year low. The index is down by more than 20% since early 2022, while the Western markets are trading at all-time highs. Their regulators, and perhaps Xi Jinping in particular, are now all doing what they can to stabilize the situation. However, the Communist Party is taking actions that are more Mao Zedong and less Adam Smith. They are now imposing stricter censorship for all public communication regarding markets, and Xi Jinping is apparently urging officials to promote the bright prospects of China's economy. Not only do they try to paint a brighter picture than reality, they are now also imposing stronger regulation to short selling, and institutional investors are no longer allowed to sell more shares than they buy during the first and last 30 minutes on every trading day. I would want to say to Mr. Jinping that the short sellers are not the issue. The issues are the issues. In January, China saw deflation of 0.8%, and consumer prices there haven't fallen this rapidly since the global financial crisis some 15 years ago. The only good thing about that is that China's deflation should have a slight deflationary pressure also to the rest of the world. Let's cross our fingers for that. By the way, speaking of fingers, it would be highly appreciated if you would hit the thumbs up button. You know where to find it. 265% growth? Nvidia, is that you? On the 21st of February, Nvidia published their Q4 results, and boy was that a slam dunk. Not only were the revenues and the margin development stellar, but the founder and CEO, Jensen Huang, didn't disappoint the investors either. He said this towards the end of the Q4 conference call.
Like AC power generation plants of the last industrial revolution, Nvidia AI supercomputers are essentially AI generation factories of this industrial revolution.
One can understand that the market bids up the price of a company like this. The PE ratio is around 60 on last 12 months earnings. But with Q4 earnings times 4, which is an incredible simplification, but I guess as good as most others, the ratio shrinks to 38. Still very high. Still demanding stellar performance also from that point onwards. But then it has similar future expectations as those of Microsoft currently, which also trades in that vicinity. If you look at 30-plus analysts who cover the company that have provided guidance for 2024, the PE should be down to around 30 for the next year's earnings. Nvidia is a remarkable company, and it now has a market capitalization that has surged beyond those of Google and Amazon. Only Microsoft and Apple remain ahead. Apart from the obvious technological lead, Nvidia's got a fabulous business model which now really starts to show. By having the production go through TSMC, the Taiwanese giant in semiconductors, Nvidia only had to increase its operating expenses by 25% to increase sales by 265% in the last quarter. That is great operational leverage. Currently, Nvidia and AI overall have all the necessary ingredients to create a bubble, and perhaps we should have listened to Soros. When I see a bubble forming, I rush in to buy, adding fuel to the fire. For me, personally, Nvidia is just too hard to value.
You know nothing, Jon Snow.
But what are your thoughts? Is AI becoming a bubble? It would be interesting to hear your thoughts in the comment section. before we hear about how Javier Milei's shock treatment in Argentina is going, let's hear from today's sponsor. And that is me. For a decade now, I've been successfully investing my money in the stock market, and I have managed to continuously beat the index. That top graph is me, by the way. Many of you have been interested in knowing exactly how I go on about picking my stocks and how I run my portfolio. I figured that instead of telling you, I could show you. So, as of recently, there's now a Patreon where you can join me and a lot of others like yourself in a practical, case-by-case and more private setting. So, for exclusive content and my full portfolio, head over to the Patreon page. See you there. Argentina in rehab. Last month, I reported on the situation in Argentina, where the libertarian economist Javier Milei recently took office. I promised to update you on how his shock therapy would progress. Well, in January, Argentina's inflation soared to 254%, up from 211% in December. However, this was still according to plan, and a brief acceleration in inflation was among the things that Mr. Milei meant when he was saying that things would become worse before they got better. The accelerated inflation was the effect of Mr. Milei's devaluation of the peso and the abolishment of price controls. Previously, there was a somewhat fictitious value of the peso, which was an effect caused by the previous administration's exchange restrictions. One just hopes Mr. Milei knows what he's doing, because with 40% of Argentinian population living below the poverty line, he and his cabinet are walking a fine line. But basically, their goal is to steer Argentina clear of hyperinflation, defined as perhaps 50% inflation per month. If Argentina can avoid that, well, then maybe it is a job well done by Milei. An analogy, which I hope doesn't offend too many, as it is meant in a hopeful and not a demeaning way. Argentina is like a junkie that has become addicted to fiscal deficits due to incompetent policymakers who have continuously spent money that they don't have.
This is fine.
Now, foreign investors don't trust the junkie because it is still addicted. Mr. Milei is the doctor who forces his Argentina into a rehabilitation clinic. But rehabilitation always starts out ugly, which is what we are currently seeing with even steeper inflation and increased poverty. But given that the junkie gets out on the other side, society, or foreign investors in this case, can start trusting the former addict again and help building it up. Have you packed your bags? With inflationary pressure, soaring interest rates, and a supposedly weak consumer, who would have thought that tourism would still be thriving? TUI, Europe's biggest tour operator, has seen their sales numbers rise to pre-pandemic levels. Expedia is also doing incredibly well, with sales at all-time highs, and a market valuation not far from all-time highs either. As investors, we want to avoid the trap of being lured in by low valuations at peak earnings. Because most likely, companies like TUI and Expedia will look the cheapest right before the cycle turns downwards, as most cyclical companies eventually do. From 2007 through 2009, TUI lost roughly 40% of its sales. Typical cyclicality. But as tourism currently shows great resilience to the current environment, it begs the question, has something changed? And is tourism no longer that cyclical? Either travel has become a higher priority for people, or the current supposedly weak consumer spending isn't anywhere near its low. Or there's some revenge travel still urging in people since the lockdowns in 2020. You decide. Carrefour, our champion? Inflation's hitting hard, especially at the grocery store. But there's drama in the aisles.
Okay, bite down on this, Patricia. Get ready, I'm gonna do the cured meats.
Last month, Carrefour, the big French supermarket chain, kicked out PepsiCo. No more Pepsi, Lay's, Lipton or 7-Up in France, Italy, Spain or Belgium. The grocery giant put up signs saying, "We no longer carry this brand for good reason. Unacceptable price increases." Carrefour says PepsiCo's price hikes are simply out of line, while PepsiCo blames rising costs. Who's right? It's a showdown. PepsiCo says it's fair game, but Carrefour is not buying it. Literally. Carrefour's been on a roll lately, calling out sneaky shrinkflation tricks. Last year, they put out warning signs on products that have shrunk in size but cost more. They're really painting themselves as the hero for us consumers. But let's not forget, this is also a publicity stunt, and Carrefour thrives in the spotlight. PepsiCo is a public company, and this woman is absolutely right.
It doesn't surprise me at all. I think there will be lots of products left on the shelves because things have become too expensive, and they are all things we can avoid buying. All the sodas we can do without easily. They are not unavoidable, nor necessities.
PepsiCo sells non-essential goods. Shouldn't PepsiCo have every right to set their price and let consumers decide if it is worth it or not? Absolutely, but Carrefour doesn't have to buy PepsiCo's products either. Ultimately, it's up to us, the market, to correct excessively greedy behaviors with fewer purchases. As for PepsiCo, there doesn't seem to be any immediate issues with their pricing power. On the 9th of February, they reported their Q4 results, where they also provided guidance of 4% organic revenue increase for 2024. That's in line with their 10-year averages. Although, it does seem like their volumes are going down, which is a little bit worrisome. Overall, few supermarkets seem to have followed in Carrefour's lead, and France only makes up roughly 1% of PepsiCo's top line. But in the great scheme of things, the situation portrays the slowdown of inflation, when not even brands like Pepsi can increase prices without starting to lose customers. I wonder what March is up to. Cheers!